Stocks ended a chaotic week and month on Friday as investors weighed big tech earnings and the decision-making at the Fed under the guidance of new chairman Kevin Warsh.
New York Times is reporting that Warsh may be considering cutting down the number of committee meetings each year, undoing decades of precedent. With us in studio to analyze all of this is Michael McKee, Bloomberg's international economics and policy correspondent, and Jonathan Golub, chief equity strategist at Seaport Research Partners. Great to have both of you with us. Mike, let me start with this report from the New York Times. Colby Smith, Ben Castleman reporting last night, citing 4 officials involved in the meeting that took place over the course of the last week here. Mr. Warsh raised the idea of changing the frequency of FOMC meetings at the Fed's gathering this week. Warsh left the impression that a revised schedule could be decided on before the next meeting in mid-September, even if the changes would not be carried out until later. Obviously, lots of knock-on effects here. You would travel to Washington less. The market would get less information.
Fewer seller points. It's very, very unfortunate.
Talk to us a bit about the ramifications of this. This is a new Fed chair who has not made a secret of the fact that he wants to change the way in which the Fed communicates. What would it mean for folks like you who cover the institution, for markets, for economists as well?
Well, for people who cover the institution, it's not going to make a big difference. But the question is, why do you want to do this? The Fed went to 8 meetings a year during the Volcker years, and so it's become the pattern that markets and companies are used to. And if you have fewer meetings, you would have fewer opportunities to at least have a planned move in the markets. I mean, you can always do a surprise move, but unless you really want to surprise people, and I don't know why you would, it doesn't make a lot of sense to me on the top. Now, I haven't talked to Kevin about this, but,
sure,
but I would like to. But for people who are in the markets, companies who are making spending plans, having fewer opportunities to see where interest rates are going is not going to be good. It's less planning, less efficient. So I'm not exactly sure what he thinks he's going to get out of this.
Jonathan, what's your take on that? Because, I mean, legally, they're only required to do 4 per year. Is that all that's really necessary? Or, you know, as Mike was talking about, this is a time when people are looking for stability. Why throw any kind of disruption into the system?
Well, it's very parallel to the conversation we're having in equity land about having, you know, companies not reporting quarterly, reporting semi-annually. And when people ask them about it, it's the same thing. Give me a company that's going to go from 4 reports a year to 2, and I'll give you a company whose stock price is down. The market does not like the additional uncertainty, or the moves are going to be more clumpy. You're going to have, if the Fed wants to raise or lower rates, they're going to have to move less frequency in bigger amounts. The speculation around that goes up, the volatility goes up, and the value of assets, whether it be equities or bonds, is lower in that kind of an environment.
Jonathan, we're going to talk about earnings. I know you want to talk about that, but let's talk about the distinction that we saw in stark relief this week when the Fed chair was talking to reports. So there's forward guidance, and then there's kind of clarity on what the reaction function is of this Fed. What were your impressions as you watched and listened to the Fed chair this week? We saw markets react strongly to what was happening, yes, more so in the fixed income space, but what did you make of the way that he's approached the position there in that second meeting?
So, you know, my take on how important the Fed is different as an equity guy. What matters most in order of importance is not short rates, but number one is, what is a credit spread? What is our belief that companies are going to make good on their debt payments? And in the last few days of the month, credit spreads substantially widened out, which meant that the market sees greater risk. The second thing is, what is the long end of the curve doing? And that steepened out further. So putting aside what I thought about the short end of the curve, which really doesn't matter, the long end of the curve and credit spreads were a really big negative for stocks.
Mike, I want to ask you, last time you were here, we were talking about how it was Warsh's first big meeting and holding everybody together, and there seemed to be some consensus, but he said he was open to having these debates, and we're going to play you some sound about what he said about possible family fighting.
I asked for a good family fight, and I got one. Most of our discussion were on the big questions that matter to the conduct of monetary policy. We didn't sort of hide from them. We weren't scared of them. There was a lot more interaction between and among my colleagues. It was a real family fight. That's the better way to get policy right. That's our North Star.
But for now, they're holding rates steady. Does that fight get a little more cantankerous if they decide to actually change policy? And can he navigate that?
Well, I'm not sure what he means by a family fight. This isn't La Cosa Nostra. It's not. It's
One would hope.
Not whacking.
I mean, my last name is Ruffini, so thank you for making a reference. I understand. Carry on.
But because they have these discussions every meeting,
Yeah.
and they've been doing it for decades.
It's part of the gig, right?
Yeah. And yes, there's probably more arguments now because Warsh wants to make a lot of changes. But the real issue is who's on what side. And at this point, it looks like there are more and more people at each meeting who are thinking about wanting to raise rates. We got the late story from the FT yesterday that Alberto Musalem believes as they do. And we know that Jeff Schmidt believes as they do. So you've got 6 people at least who are at this point thinking that maybe you need to raise rates, which will drive market trading between now and September 18th. The data that we get will probably be more important, but people are going to be discussing this. And that creates volatility, as Jonathan was saying, that the markets don't like.
Let's move to earnings if we can. The Fed a huge component of this week, but a lot to make us exhausted and prompt us to exhale here on this Saturday morning. So, Jonathan, we've had all of this agita about AI. What's this spending leading to? And so from the companies that reported this week, and there was this stark divide between those who seem to be making money and making hay out of all of the investments they've made and those who haven't. What clarity did you get on that question of whether or not there is reason to be concerned or worried about how many billions of dollars are going into this space right now?
Well, I mean, let's frame what earnings season looks like. This is by far the best earnings season ever in history.
Outside of tech, across the board.
No. Forget about tech.
Yeah.
It is the best earnings season we've ever had, except in periods where you're bouncing out of a recession and you're comparing against, broken numbers. So just to put things in perspective, overall, earnings are expected right now to be up 50% compared to a year ago. I can't even describe how insane that is. I think in the post-pandemic period, the average has been 9.5% growth. Some of that is funky things that are happening with the numbers related to, passive investments in AI companies. If you strip those out, you're left at 30%. But let's talk about the real big surprises. We went into earnings season, the banks were expected to grow less than 8%. Right now, the expectations are the banks are going to finish with 22%. The oil companies related to the war in the Middle East, well over 100% on earnings growth, and for the most part, the rest of the universe outside of tech is fine. So it's huge. A lot of this, however, is related to the same thing. Why the banks are making money? Because they're lending into, there's more capital markets activity and the like. So there is one big ecosystem around this stuff.
One quick follow-up here just about kind of the integrity of the so-called Magnificent Seven. Again, I brought up that kind of divide in terms of how these companies are doing. Is that still a useful kind of categorization for you? Is the Magnificent Seven dead, I guess, is my stark question.
I don't know if you would define the most important.
Slightly less magnificent.
Well, no, not even slightly. I mean, if you take a look, like the average company in the S&P is expected to grow 12 is 12.
Yeah.
And the overall is 50, as I said. So there's a huge bias by these big tech companies, but you'd have to throw other names in there. Broadcom, you'd say, well, does that really belong part of the pack? Probably. Right now, in terms of companies that are most important, would you throw Micron in the memory company? So it's a slightly broader list of those, but it's still mega cap tech is a horse that's pulling the wagon.
Yeah.
Mike, I thought about you yesterday. We were interviewing these governors, not just because they were wearing excellent hats, but because they were talking about task forces. And this has been a big thing. Warsh, he's got all kinds of task forces. And you asked him about one specifically when it comes to the AI question. We're going to play some sound.
What vetting did you do of the people that you appointed to the task forces? In particular, given Mark Andreessen's substantial political spending, $25 million in just the past year to back candidates who oppose stricter AI regulation, how can the public be confident that a committee he co-chairs will provide an independent assessment of AI's economic effects rather than one aligned with the interests of the AI industry?
Yeah, so I selected 15 incredible subject matter experts to tackle 5 of the most important questions that if we get the answers right, we're going to do a far better job in delivering. And if we get the answers wrong, we have a problem. The comfort that I can give you and your listeners is we're the decision makers. The chairman of the board of the Federal Reserve and the members of the board and the FOMC, we will be the consumers of the outputs from 5 different committees. The judgments we're making will be informed by, but not at all determined by, these outside groups.
Was that a satisfactory answer to quell some of the criticism here?
It's probably the only answer he could give because obviously Andreessen comes into it with a point of view, and they're going to get that point of view. And he basically said, we know that we're going to get that point of view. Now, you have to also know that Mark Andreessen is a longtime friend of Kevin Warsh's. They went to school together at Stanford. So that's another reason that he would be on the committee. But it's a little less worrisome in the AI space because it's not something the Fed really regulates, or it's more like, how could this affect the economy? But it's still a question when you have somebody who is so blatantly on one side of an issue of what kind of advice they're going to be given. Warsh says, I know that.
Jonathan, you mentioned sort of the activity we've seen in capital markets, and we had the SpaceX IPO, we had the ADR of SK Hynix. How are you feeling about the prospects of the other companies going forward? We had a couple of consumer IPOs this week and kind of branching out, as we've been talking about here, beyond just these big tech names.
It's a really big deal. I mean, at the end of the day, it's not only an AI story. This is a CapEx story and a capital raise story. The amount of money that's being spent is extraordinary, and companies need to raise that capital from somewhere. And the market at some point in time gets really uncomfortable with that. I mean, companies in many cases are raising money that they don't even need given their cash flows, because right now the capital markets are open. But bond investors are looking at this and saying, am I going to get an appropriate return? In many cases, you have a data center that has a 15-year life, and that's a really long commitment to make on technology for a couple hundred basis points over Treasury yields. Michael, I just a question for you as it relates to this Warsh conversation. Is now the time, right out of the gate, to be talking about procedures when there's all this debate? Inflation is higher, budget deficits are higher, oil prices are higher. They're soliciting Congress for more budget, budgets, and then you're talking about how many committees you're having and how many meetings you're having. Is it tone deaf? And does the market look at that and say, look, are you listening to what the debate should be?
As Alberto Musalem put it to the FT, Mr. Market is sending a message that they don't like this. The chair has come out, the new chair has come out and said over and over and over again that our goal is to bring down inflation and we're going to get to the 2% target. But then all he's talking about are these task forces, and it's almost as if they invented the Fed right when his first meeting was. It's not like the Fed hasn't been talking about all of this stuff and what needs to be done. And if the rest of the committee doesn't have views on this for some time now, for years perhaps. So I'm not sure why I can understand why he wants to do something at the beginning of his term, but why to make that front and center as opposed to monetary policy?
Great to have both of you with us. Really appreciate this. Michael McKee, our Chief International Economics and International Policy Economics Correspondent, and Jonathan Golub of Seaport Research Partners joining us here on set in New York.
Excellent question. You can come have my job next time.
No.
I'll get a coffee.